All right, so in today's video, I'm going to be talking about LEAPS for small accounts. So how do you trade LEAPS if you don't have that big of account? So ever since I released my video on my LEAPS strategy, my YouTube video, I'll put the link at the top right hand corner of this video so that you can take a look at that video if you haven't already. And in that video, I share how I actually trade LEAPS. And I've got a number of you that have reached out to me after watching that video saying that, you like the LEAPS strategy. However, it's a little bit too capital intensive for their account. So this is where they ask, how can they adapt my LEAPS strategy for a small account? So I think that's a very good question, and that's the reason why I'm creating this video. So first of all, as you can see over here, these are some of my LEAPS positions that I have on the QQQ. So if you were to take a look at the cost over here, you can see that it's not that cheap. It's pretty capital intensive. So each of these options down here, which I have bought, it is about 20 plus to $30,000. You can see this is 32,000. This is 26,000. And these two over here are two contracts. So they're about $30,000 each. So how can you trade LEAPS if you don't have that big of a capital? Let's say, for example, you have 10,000 and lesser. So I'm going to give you a few suggestions on how you can trade LEAPS on your account if you have a small account. How do you adapt this strategy to a small account? So the very first way I would say is to go for a lower price underlying. So this can be lower price stocks, or you can go for the lower price index ETFs. Now, generally for the lower price stocks, if you want to use the LEAPS on it, I would prefer if you do it on fundamentally good stocks. That means to say the company of the stock has at least been profitable over the past few years and the fundamentals are strong. So there are quite a number of things that goes into fundamentals, which I won't go into here. You can easily research on Google. But one of the issues or challenge that I found is that the lower price stocks, they do not tend to be the fundamentally good stocks. Usually fundamentally good stocks are a little bit more expensive. So that is a little bit hard to find. But although there can be a few that can be found, you just have to do a little bit of digging. Now, the alternative to that would be to go for the lower price index ETFs. So for example, QQQ is the tech index ETF. So if I was to go to one of these options down here to buy the LEAPS. So generally for myself, I like to go very far dated ones, very far DTE. So as you can see, this one is about 519, but when I first put it on, it was much higher. So let's just say we go for the furthest one, 883. And usually I like to go for around 70 to 90 deltas. So if you go for 90 deltas, there will be more intrinsic value, less extrinsic value, which is what we really want when we are trading LEAPS, because when you're buying options, extrinsic value is always against us. So when you go for the higher delta, as you can see over here, the extrinsic value gets lesser. And if you're not already aware, over time, as we get closer to expiration, this extrinsic value will slowly start to go down to eventually become zero at expiration. So that is why when you go for the higher delta, you're going to have lesser extrinsic value, which has less impact to reduce your overall value of your options. If you will go to the 70 delta one, let's just say we go to the extreme over here, 70 delta, which is actually fine, by the way, as long as you don't go until too far out of money, like let's say, for example, 50 delta, that is going to be pretty much all extrinsic value, as you can see over here. So with the 70 delta one, it's going to be much cheaper, but you're going to have more extrinsic value. That means to say if the market do not go up as quickly over time, then all this extrinsic value will slowly start to go down to zero. So over here, you can see that if you go for the lower delta, it's going to be much cheaper than if you go for the one at 90 delta. As you can see over here, this is $303 on the ask, which just means it's about $30,000 per option contract. Now on the other end, for the 70 delta one, you can see it's about $130. That's about $13,000. So that's still quite expensive, right? Especially if your account size is less than $10,000. So the alternative for this QQQ Tech Index ETF would be XLK. So XLK is also the index ETF for the technology sector, as you can see over here. And it's actually lower priced than QQQ. This is $260, whereas QQQ is at $562. So naturally, the options are going to be more expensive over here. So let us take a look at XLK. Now, one thing about XLK is that the options are not as tight of a bid-ask spread compared to QQQ. So if I was to go to the same 883 days, you can see that the spread is generally wider. It's about $10 wide. So if you don't mind this, this is one alternative that you can do. And let's just say we go for the 90 delta option. It's about $126. So this will cost you about $12,000. And if you go to about 70 deltas, let's say somewhere around here, or maybe even 80 deltas, somewhere around here, it's going to be much lesser. So it's going to be somewhere in the vicinity of around $6,000 to $8,000 per contract. So this is going to be less expensive, less capital intensive compared to QQQ. So this is one alternative that you can consider if you want to consider a tech index ETF. Now, if you find XLK still a little bit too expensive, maybe because your account size is much smaller, then the other alternative would be to use the other index ETF, which is the financial index ETF, and that is XLF. So XLF, if you're not familiar, basically this tracks all the financial stocks. And let me just very quickly show you the chart as well. So as you can see, this is the XLF. And this is also what I consider a positive drift underlying as well, because over the long term, it wants to go up. Now, of course, it has a very big crash in 2008, mainly because it is the financial crisis. So being a financial index ETF, this really took a very big hit. It went from I think about $30 or so. It dropped down to the single digit dollar, right? Maybe around $5. So it was a really big crash. But after that, the market starts to pick up and eventually it breaks through the highs and it continued going up. So this is one of the underlyings that you can consider because the price is not that high. So if we were to take a look at the call LEAPS options for this, and we were to go to 883 days as well, the furthest dated one, and we go to, let's say, the highest delta, which is around 90 delta, it only costs you about $27, which is about $2,700. And the extrinsic value, relatively is not that high as well. It's only about $1.93. So that means to say you pretty much retain a lot of the value, even though XLF do not move, let's say after the expiration date, 883 days later, the price pretty much is at the same price as when you first bought the LEAPS. So all you're going to lose is just this extrinsic value because the remainder is the intrinsic value, and intrinsic value does not decay over time. So if you were to go for the 70 delta, it's going to be much less expensive as well. It's going to be about $11. So it's going to cost you only about $1,100. So XLF is going to be one consideration if you don't mind the risk attached to it. So the question is, how did this strategy do over the past 5 years on XLF? So for this, let's head on over to the Tasty Trade platform where you can access the backtesting tool. So the backtesting tool is going to be, a pretty good tool for you to at least analyze any strategy that you want over the past few years before you actually put on the trade. So if you see the backtest has a chance of it being profitable, then at least you're going to have a better chance of it being profitable when you start placing the trade live. So any strategy you want to put on, I would say if you do not have any statistics to back up that certain strategy that you're trading, at least lean on the backtesting tool to kind of get an idea as to how it can perform over the past number of years. So at least it gives you a better indication of how it might perform in the next few years. So over here, I've already populated some of the fields over here. You can see I put XLF and we're just going to test over the past 5 years. And the delta that we're going to choose usually, like I mentioned, is 70 to 90 delta. So for this example, I'm going to put 80 delta. And the expiration date is anything from 365 days and above. So for this, I'm just going to put 365 days. And I'm going to exit at around 90 DTs. So basically, we want to exit the options before the theta decay really kicks in. So the theta decay really kicks in somewhere from 45 days and below. Right, so if you want to play it a little bit safer, whereby the theta decay does not really kick in, then you can go for somewhere around 60 to 90 DTs. So anywhere from that range is absolutely fine. So in this case, I'm just going to use 90 DTEs, and then I'm just going to hit the run back test, and let us take a look at how it performed over the past 5 years. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Okay, so the results are out, and overall, it is going to be net profitable. Although sometime in 2022, it's going to have a drawdown period, which is natural because this is a bullish strategy, and 2022 was a bear market. So naturally, the strategy is going to be in a drawdown. So the return for your used capital is going to be about 208%. Drawdown is about 40%. So if we were to compare this to if you were to just buy and hold the stock, it's going to be a better performance. So if you were to just buy and hold the stock, it's about 135%. So 280% is much higher than that. But at the same time, your drawdown is going to be higher as well. So if you were to just buy XLF and hold it, the drawdown is going to be only about 25%. So if you were to use the LEAPS, the drawdown is naturally going to be higher. Why? Because this is a leverage position. When you buy options, this is going to be a leverage position. So what it essentially is doing is just magnifying the underlying performance. That means to say, if it's going to be a net profit overall, the net profit is going to be higher, but the drawdown is going to be magnified as well. And at the same time, if let's say, for example, it's going to be a loss. So let's say if we were to take a look at 2022 by itself, then XLF is going to be in a loss. If you're going to use LEAPS on that period, then your loss is going to be magnified as well. So you're going to probably have a bigger negative return compared to if you were to buy and hold stock. So this is very important to understand when you're trading LEAPS. So the most important thing is that as long as you continue in the position, let's just say that you want to be in the position for the long term, then as long as the underlying goes up, your performance, your results is going to eventually going to be a net positive as well. That is why it's important to choose a positive delta underlying either index ETF or a fundamentally good stock. Now, the next thing, let us dive a little bit deeper into some of the details down here, and let us take a look at the year-by-year performance. Overall, the win rate is about 83%. Only because, right, it has been pretty bullish over the past 5 years and with one big loss. Now, the most important thing is to see what is the average buying power per trade. That means to say, what is the cost of putting on the trade on average? So it's $763. That means to say, if you have an account size that is 5,000 or smaller, you can definitely put on the LEAP strategy on your account with XLF. So let us go to the details, or rather the trade by trade analysis at the logs over here, and let's take a look at how much it would have cost you per option. So you can see that this is the buying power. So the average about 700 plus, as mentioned in the details section. So when you first put it on, right, it's roughly around 585, then 695, 835, 923. Now here's what's the most important thing to understand. So whenever you have a profit, after you roll it, you're usually going to use lesser of the total amount. So let's say, for example, the very first trade you put on is $585. You made $945 for that. So your total that you get, including the capital you put in, is going to be $945 plus $585. So roughly it's going to be about $1,600. Now, when you roll it, generally we want to roll it back to the same delta that you have used previously. So if you have used 80 delta previously, then you're just going to roll to 80 delta. And at the point of time, you can see that for this roll, it's going to cost you $695. So out of the total of $1,600, that you have in the capital based on this transaction, you're only going to use about $700 for the next trade. So you pretty much have some leftover. So this leftover, it will generally be used if it's going to be in a loss. So for example, you can see over here, $835 for you to put on this trade. Now it's going to result in a loss of $613. So what it means is that out of this $835 that you have put into for this position down here for this option, you're only going to end up with about $200 left because you have lost about $600. So out of the $200 that you have left, if you were to roll to the next trade, which is down here, at the same delta, you can see that it's going to cost you $923. So you only have $200 left of this position. So what do you have to do? So this is where you do have to top up. So it's very important to understand. So you do want to set aside some capital in case you hit a loss for the year. So let's just say, let me just remove all this. So let's just say the very first trade you put on is not this too. Right? The very first trade you put on, a little bit unfortunate, happens to be a loss. So you put in about $835. At the end of the day, you're going to be left $200 plus because you have lost $613. Now you need to top up to put for this trade. So this is very important to understand when you're trading LEAPS. That means to say, if you, let's say, have a $5,000 account, you do not want to put the whole $5,000 into the LEAPS. So some people will do that. For example, they see that, oh, it costs $835. I have $5,000. I'm just going to max out my capital to buy all the LEAPS position that I can get with the 5,000. No, you do not want to do that, because you have to expect that certain trades can be a loss where you do need to top up. So this is very important to understand. All right, so this is the first way that you can trade LEAPS if you have a small account. Now, the next way that you can trade LEAPS with a small account is to modify the DTE a little bit. That means to say, instead of going for the very far out DTE like 800 plus days, you want to go to a shorter term. So I would say somewhere around 180 days if you want to have a lower cost for your LEAPS, because you will find that if you go for the lower DTE, the cost also drops as well. So if I was to compare this, so let's just say I was to go to around 80 deltas. 80 deltas, you can see over here, it's only $83. And if we compare this to the 883 days at around 80 delta, so let me just go all the way up, you will see that the 80 deltas here is going to cost much more. So 80 deltas is the same delta, but it's going to cost you more than 2 times the cost of one on the 180 DTE. So this is one way that you can work around if you have a smaller account. So this will still be considered LEAPS, because LEAPS generally, at least the technical term, is anywhere from 180 days to higher. So at the minimum, let's just go for around 180 days. And if you want to make the price even less expensive, then what you can do is you can go to around the 70 deltas, because what you notice, like I've showed earlier, if you go for the lower delta, you're going to have generally a lower price for the option compared to if you go for the higher delta. So if I was to go to 90 delta, you can see that this is about $138 on the ask. So this is going to be more than 2 times the cost of the 70 delta. And 70 delta, I would say, is the lowest delta you want to go, because any lower than that, the extrinsic value is going to start to increase, where it's going to pretty much be all extrinsic value in your options. That means to say, if the underlying, so for this, I'm using SPY as an example, which you can definitely use, especially if you're more risk averse. You don't like to go for the tech index where it can be much more volatile. So S&P 500 will be less volatile. And using this method, you can actually put it on a smaller account if you go for the 180 DT. So why you do not want to go for the really out of the money options down here, even though they are so much cheaper, is that what if the next 5 years, the market just goes sideways? If it goes sideways, then pretty much what's going to happen is you're going to lose all the value down here. So that means your option is pretty much all going to zero. And that's not what I like. So if you were to go for the higher delta ones, at least your extrinsic value is not that high. So you do have some buffer in case if the market just goes sideways, you do not lose as much. So if you want to go for a lower cost, you can definitely go for the 70 delta one. So it's going to cost you about $5,500 to put one of these options on. So again, let's take a look at the performance. Very important. We always want to lean on statistics, results, to take a look and see how it would have performed over the past 5 years. So again, let's head on over to the backtesting tool, and I've already populated the fields over here. So I'm going to go with 70 delta, and over here I choose 180 deltas. Now for the exit at the specific DTE, I'm going to put 45 DTE instead of the 60 to 90, because if you're going to put the 90 DTE, while it's possible, you're going to be much more active. You're going to roll it much more often. And generally for LEAPS, I do not like to roll too often. And the main reason is because generally with LEAPS, it's going to have more cost if you're going to keep rolling because of this bid and ask spread. So every time when you roll, you're losing to the bid and ask spread. So as you know, if you go for the higher delta ones, you can see the spread can just pretty much be much wider. So every time you roll, you're going to incur this spread cost. So that is why I put at 45 DTE to roll, so that we don't roll as often as compared to the 90 DTE. So 45 DTE, that's the point where the theta decay is going to start to rapidly increase. So we want to get out of the trade and start to roll it before it gets to the point. So I'm going to hit run back test, and let us take a look at the results for the past 5 years. Okay, the results are out, and as you can see, LEAPS on SPY again is going to be a net positive after a number of years, although again similarly in 2022 it's going to be in a drawdown again because it's the bear market. So it's very important to stay the course if you plan to trade this for the long term. So my strategy for LEAPS generally is going to be a long-term kind of position. So we can take a look at the returns over here. It's 249%, and the drawdown is going to be about 53%. So the drawdown is going to be pretty high as well. And again, like I mentioned, it's because we magnify the underlying results. So how did SPY perform if you just buy and hold? So if you were to take a look at the buy and hold position down here, the return is 94%. So by using LEAPS, you dramatically magnify the return. So you're going to get a much higher return, but at the same time, of course, your drawdown is going to be more than if you were to just buy and hold. Buy and hold is about negative 25%. So with LEAPS, you're going to magnify both the profits as well as the loss. Next, let us take a look at the details and have a more detailed look as to how it performed in terms of the trade by trade. So the profit rate is about 69%, again, because over the past 5 years, mostly it's bullish. And what about the average buying power? So the average buying power is about $4,000. So if you have account size about $10,000, this is going to be okay as well. So next, let's take a look at the very important log section, because now it tells us what is the amount that we might have to top up if it's going to be a loss for the year. So similarly to what I shared with you in XLF, if you do come across a loss, then this is where you do need to have some capital to top up again. So in 2022, this one down here is going to be where you're going to have probably the biggest loss. So you paid $4,600 for buying the call LEAPS, and at the end of the period, where we get to roll at around 45 DTE, you're down 4,500. So essentially, the whole value of this call LEAPS is going to be gone, right? All you're going to be left is maybe less than $100. So you can see the ROI here is almost 100% loss. So this is something that you do have to note. And so you do have to set aside, again, capital in case this happens and you want to roll. So the next amount is going to be $5,000. That means to say you pretty much have to top up the $5,000. And then if you're going to lose about $3,000, it becomes $4,000 next. So you have to top up probably about $2,000 or so again to resume this position. So at this point of time, you have lost total about $7,000 thereabouts. So this is very important. That is why we do not want to put our whole capital into all the positions. This is something that a lot of beginners make the mistake. You do want to set aside some capital, right, for in case the market actually crashes, and then you need some capital to start to roll. So as long as you continue doing this, as you can see, when the market eventually becomes net positive, when the market starts to recover, you're going to get the profits as well. So one alternative is that you can actually time it if you want to. That means you wait until, you know, maybe you're following technical analysis or support and resistance, time it until you find a better entry point to put on the LEAPS, you can do that. So if you have a small account, you can definitely trade the LEAPS strategy as well, as I've shared the two methods in this video. So hopefully this video has helped you, and if it has, I would greatly appreciate if you give me a thumbs up on this video, and also subscribe to my channel for more options trading videos like this, and I will see you in the next one.